Now, this may be a boring week, especially Monday, Tuesday, and Wednesday, because everybody knows NVIDIA reports Wednesday after the bell.
Mm-hmm.
So a lot of people are probably not going to put on a lot of risk ahead of that event.
Just in case it goes against us, or
yeah. Well, I mean, if NVIDIA has a big move one way or the other, you don't know which way. But if it goes up 25% or goes down 25%, that's going to move the ES and the NASDAQ, because it's one of the largest components of those indices.
Do you ever play strangles on our earnings?
Sometimes.
Sometimes.
I used to do it a lot more than I do now. I just got tired of, especially the naked calls on them, because on an earnings event, the stock is almost certainly going to move. Not always, but if it doesn't, yeah, you get that big juicy premium. You get the volatility coming down, the volatility contraction, which you have two short options and a strangle. So you get twice that vega that you get to capture there. So it's nice when you win, but when the stock makes a big move and blows through one of your short options, then it's a headache, especially on the call side. On the put side, you could always accept assignment of shares, but you can't really do that on the call side, because you don't want to be assigned short shares of stock typically.
Yeah.
Because we talked about this the other day, most stocks are hard to borrow, meaning there's not a lot of short shares anyway for you to get. And even if you can borrow the shares to short, the reason it's called borrowing shares to short is because your broker is essentially loaning you out shares for a fee. You pay a percentage to your broker to hold those short shares. Mm-hmm. You're actually paying money the whole time you're holding those short shares. Strangles are not my favorite for earnings. I would much prefer, if you're going to do a delta neutral trade, stick to iron condors. Iron condors make a lot more sense there, because that call, if a stock doubles in price, for example, it's not the end of the world on an iron condor. It'd be a serious situation in a strangle.
Okay.
Have I played SMH any this year? It looks like I played it a couple weeks back because I made a little money on it. What is my year to date? I've played it 3 times. Won on it every time. What have I done on it? Short put, bullish trade. Short put, bullish trade. Put credit spread, bullish trade. You know what? I've convinced myself. Let's just do a bullish trade. Let's see. The 33 delta short put and the 28 delta long put. Risk 360 to make 140. And it's 53 days out. If it, goes down, I can just hold on to it. It's defined risk. Hold on to it for the next 2 months and hope SMH eventually comes back. See if we can find something with high IV that doesn't have earnings. Qualcomm, another chip manufacturer. See what Qualcomm has done lately. Chart looks pretty much like Micron's. I don't really pay much attention to Qualcomm. I don't really have any kind of directional assumption, but an iron condor in here, one standard deviation, yeah, looks good. 145 versus 355. And because it's already had its earnings, hopefully IV rank will come down. Probably the only reason its IV rank is elevated is because of NVIDIA on Wednesday. After NVIDIA reports on Wednesday, probably IV rank in Qualcomm will come down. So I think I'm going to do this one. Feel a lot better about this one than doing one in Micron. The prices on these options is really moving around. See, the bid-ask spread in Qualcomm is not great. I'm going to try to get 150, risk 350. And see if that gets filled. It did not. I may let that sit for a minute and see if it eventually gets filled. The home building sector just had this huge candle on Friday where it went from 114 to 119. Because there were 2 or 3 home building companies that reported earnings. Smaller companies that I don't pay attention to, but they had good earnings and they moved the home builder ETF up. So I've already rolled the strikes to try to protect that short call, but I'm going to have to probably roll the strikes again. Looking at the deltas. So typically on strangles, I put them on around 16 deltas typically. You see my put is sitting at a 13 delta my call is sitting at a 28 delta. And that means the underlying has risen in price, and it's made my formerly 16 delta call now nearly a 30 delta call. Not really in danger yet, but if in a day or two I come back and check this and it's sitting at a 35 delta or a 40 delta, that means that call is really getting in trouble. And I probably need to roll and adjust the strikes. And by rolling, I mean just rolling the strikes up or down. In this case, I would roll the strikes up. I'm going to have to pay some money to make my call safer. So, if I move my call up, it's going to cost me some money, but that's fine because I'll also roll the put up. And the put, I'm going to receive a credit for rolling it up because I'm putting it in more danger. So whatever I do with the put should offset what I do with the call. Well, essentially, in the end, I really don't pay anything to make this thing safer again. Put it back to like a 20 delta strangle on each side. Let's see, I'd have to pay $17 in this case, which is nothing. Originally, I received a max profit of 200, a credit of 200. I'd had to give up, $15 or so to roll it to make it a little safer. If I wanted to make sure I received a credit on rolling, I'd just bump up the put one more strike, and now I could roll for a credit. So
yeah.
You don't want to add to your risk. One stock that made a huge move this morning was PDD. I don't know if you pay attention to the Chinese stocks.
No, I don't. Are those, do you like to play on those too?
I don't play them that often. Sometimes I'll trade Baba and Baidu. Those are two of the more popular and liquid Chinese companies. PDD is very liquid as well. This is a Pinduoduo, and it had earnings, I guess, before the bell this morning. I didn't know it was having earnings, but you can see down $37. So it went from 140 to 102 this morning. That's huge. That is a huge drop. Now it's like a 40% drop. So,
oh wow, yeah.
A lot of people, made a lot of money in that stock this morning. A lot of people got hurt this morning too. So, yeah, that's a serious move.
Yeah, that's a gap down.
Yep. Well, it had earnings before the bill, so yeah, it opened.
How do stocks move like that before the bell? Is it because I've never really understood that?
Oh, trading starts a little. You can trade stocks prior to the stock market open. Like on Tasty, I believe you can start trading. I'd have to check. I never trade stocks pre-market.
Yeah.
But you can, I think, at least an hour or two before the bell. And then after the bell, they trade till 7 p.m. So even though the stock market itself is closed, there is pre-market and after hours trading for stocks, a couple hours before and after. So if you got any stock positions that make a big move, for example, after the bell on an earnings event, you want to go ahead and close them out, you can. Of course, I'm not usually playing stocks for that kind of stuff. I'm playing options, and the options don't trade pre-market or aftermarket. They only trade during market hours.
Oh, funded futures. She wants to know if you trade funded futures.
I don't know what the hell funded futures is.
She said because you play with house money.
Oh, I don't. She's talking about being a funded trader. She's talking about being a prop trader, proprietary trader.
Oh, what is
that? Yeah, that's not something I'm interested in at all. So what that is a lot of people that imagine themselves as being a good, especially day trader, they go sign up for these prop firms, these proprietary trading firms. And usually there's a test involved. You have to prove that you can kind of trade. Usually you have to pay them money to get enrolled into their program. But once you get enrolled, then they fund you an account. They give you an account, not your money, it's their account, right? But you trade it, and you have to trade by specific rules that the prop firm dictates. And if you make some money, they'll give you a cut of the winnings. the likelihood of you winning is extremely small, just because of the style of trading they do. It's not like what we're doing here with options, right? They're just trying to scalp futures. It's all day trades. They don't do any swing trading at all.
Okay.
So when they're trading things like ES or NQ or CL, they're placing a trade right now and they're closing it before the end of the day. They have to be out of all their trades. You know, a lot of proprietary firms are like that. Whatever they're in, they flatten out all their positions at close. You know, get out of everything.
So essentially, it's a big risk.
Well, I mean, that's people that are looking for a job as a trader. And this is essentially what they're trying to do. They're trying to get hired to be a trader.
Oh.
But here's the thing. If you think you know how to trade, why do you need to work for somebody else and trade their money?
Okay.
And a lot of people do it because, you know, these prop firms are going to give you an account. Typically, they give you account size of like $50,000 to start with, or some of them might give you a $100,000 account to start with, or whatever.
Oh, right on.
And a lot of people are like, well, dang, you know, this is nice because now I can trade these big products like ES or NQ, you know, that I can't trade on my account because I don't have $100,000 in my account or whatever. But I can go trade this company's money. But here's the thing: if you couldn't win consistently as a trader with your smaller account, you're not gonna take a larger sum of money, and it's not going to be any different. But the prop trading thing, most people are going to spend far more money than they'll ever get out of it, because most of them are going to keep taking these exams, these tests, or whatever, this trial period that they have to go through, and you have to pay for it. You have to, you know, a few $100 probably. And most people end up in their trial period, they fail. They'll give them a month of trading or whatever, and they'll blow up the account, or they won't follow the rules. So you fail that period. So then you have to go through a retest. They have to sign up, pay another few $100, and then you might have to do it half a dozen times. You know, pay the fee and go through a testing before you ever get a proper funded account, a real account with them.
Oh, right on. Okay.
Yeah, it's. And most of the prop firms, that's how they make their money. They make most of their money from selling that dream to people, rather than people actually becoming a funded trader and making money for the firm.